if you go back like the last 50 years, we're trading in the US of gold and measure silver versus silver in 20 of those 50 years was at least up to 2% of the price of an ounce of gold. Okay, right now we're 1.4%. Okay, very low. But in bull years, like in 79 and 80, when silver went up to the top of that old range, $50 highs, and in 2010, 11, when it went up to 50, it got up to 6.5% price of gold and 3.5% of the price of gold. Right now, we're 1.4. We're in a bull market. If silver goes and does what it did back then, you could see it double to triple its value relative to gold. So if gold goes up another 50%, silver, off the page.
Before we talk about price targets, before we talk about headlines, I want to show you something Michael Oliver has been warning about for years and why it's finally happening now. Michael Oliver is not a hype-driven analyst. He doesn't chase price. He studies long-term momentum, relative performance, and multi-decade market structure. And right now, his work is sending one of the strongest signals silver has produced in generations. Here's the data most investors never look at. Silver today is trading at roughly 1.4% of the price of gold. Over the last 50 years, levels like this have never marked the end of a silver bull market. They've marked the opening phase. In prior cycles, 1979 to 1980 and 2011, silver didn't peak until it reached 3.5% to over 6% of gold's price. That means even after a powerful rally, silver hasn't completed half of its historical reversion. Michael Oliver also points out something equally important. Gold itself has only risen about fourfold from its 2015 low. In the last two major bull markets, gold advanced eightfold before peaking. That tells us something critical. This cycle is not late. It is structurally incomplete. Now layer that onto today's reality. Equity markets grinding sideways after marginal highs, bond markets losing stability, and central banks quietly preparing more liquidity as stress builds beneath the surface. This is exactly the type of environment where silver stops behaving like a background asset and starts behaving like a leader. Before we go further, make sure you're subscribed. This channel focuses on structure, history, and data, not noise. If you want to understand what's shifting before it becomes obvious, you're in the right place. And I want you to think about this as we continue. If the financial system is changing phases, where should capital really be positioned? Let's hear what he says.
Michael, what has surprised you in 2025?
Oh, it's sort of surprised, but not really. The laboriousness of the US stock market, where, it was late 2024, early 2025, it was making highs, the NASDAQ 100 or S&P 500. And then came that headline sell-off. And that's what if you're a bear, you do not want a sell-off that has a headline attached to it. You want people to be selling and they can't figure out why is it going down? Because if everybody has a headline attached to it, usually it's a trap, okay? Meaning it's going to go back up again. So sure enough, Trump waved his wand in mid-April after we had a 22% S&P drop, pretty fast, March and April. And we got to a level where our reports, momentum structural analysis, said, okay, we thought this sell-off was going to occur, but right here around 4,800 on the S&P, which again was a 22% drop, it turned and burned back to the upside. Okay. Now, and they did it because Trump said, oh, we're going to hold things off for 90 days. So in other words, the headline that took you down, he sort of shoved it aside for a while. And so it's like a bunch of headline chasers. Chase it down. Oh, chase it back up. It's like little puppies. Okay. Anyway, but that kind of action, and we made marginal new highs, like 10 or 12% in the S&P. Some sectors didn't make new highs, but okay, pardon me for being long-winded. That's the way stock markets top. If you go back to 2000, the dot-com, or the real estate top in 2007, it was a whole year of laborious, boring, can't quite interpret it type action. So nobody was scared, and yet you were topping. But we did the same thing this year. We went up and took out the high we made early in the year, and then we've gone nowhere for about 3 months now, just spinning our wheels. That sort of surprised me, not that they turned back up from the level we expected, but that they went and made a new high. But it shouldn't have. It really should not have. So that was, I'd say, if there was one surprise this year, that was it.
What charts, though, would you draw people's attention to that's going on now.
What I wouldn't do is look at the price charts because when you punch on your screen gold or silver, and let's say daily or weekly, to go back a year or so, it's vertical. So you say, golly, I got to get out of that. I got to take my profits. In fact, if you go back for the 50 years that it's been trading gold, 1975, they legalized it over here. Okay. Anyway, you've had two major bull markets, each of which, if you measure from the bear low that preceded it to the bull market peak, was an eightfold gain from the bear low. Multiply bear low times eight. And you did it twice. The 1980 peak and then 2011 high. They were both eightfold. We're only fourfold from our bear low. Our bear low was in 2015, at $1,046. So we're 4,000. Okay. So if you look at your simple price chart, you say, golly, I got to take profits. I'm nervous. It's only begun. Now, we think ultimately those old highs, the eightfolds, that was a norm. I mean, you did it twice under conditions that aren't anything like what we're going to face or are facing. So to expect it to go there is no big deal. The issue is it going beyond there? And probably is. So, but there's a more important thing that's going on. Three separate charts that you can show. And the very first one's on first page of a report we had 2 weekends ago. And it's a simple, almost what you could call an idiot chart. All I do is I divide at the end of every month, and this chart goes back to 2013 when gold was coming down hard. Okay. I plot the end of each month, I divide the price of the front month COMEX future gold into the price of the S&P, and I express it as a percent. Okay, well, it was coming down hard during that gold bear market. And then for 11 years, gold has done this on that chart relative to the S&P, meaning it's had rallies against the S&P, it's sold off against the S&P, but it's gone sideways. Few people realize that for 11 years, gold has really been a par performer to the S&P. Not been a loser, not necessarily a winner. From times it is, sometimes it's a loser relative. But basically, for 11 years, it was like sideways action oscillating. We broke out of that massive range as of November. Now, what does that chart tell you? Anybody with a crayon could draw the green line we've got on that chart and say, my gosh, what a base that is. What stock is that? I'm going to buy it. Okay. Well, it's not a stock, it's a relative performance chart. And it's telling you, it's smacking you in the face. Gold is just beginning a major breakout in relative performance to the great US stock market. Okay. So any assumptions otherwise, that chart's screaming at you, no. There's a chart showing the gold miners versus the S&P. Oops, they also broke out in November on a major base pattern relative performance. And silver did too. Wow. So they're all a chorus. They're all saying, hey, we've just broken out against you. So what those charts tell you is it's only just begun. So people that look at a chart and see gold going up for a couple of years say, oh, that's old. No. These charts say the game just began. Silver measured against the gold. And silver has recently, over the last couple of years, in fact, been at very low levels of value compared to the price of an ounce of gold. And so when we plot that chart, you can see it. We just broke out also in November. So it's all the first three charts I mentioned, gold S&P, gold miners versus the S&P, silver versus, all they said, okay, we've now emerged into outperform status versus the so-called great US stock market. Now, within that monetary metal grouping, silver has broken out versus gold. So it's telling you, yes, you should be in the monetary metals, one form or another, but you really should be more in silver. Silver looks like now it's going to beat gold handily and probably in a breathtaking way during this coming year. And I'm betting on a lot of it occurring by the time we get into the second quarter of the year.
Oliver's broader market assessment begins with an observation that should not be ignored.
This is where Michael Oliver's work becomes critical, because he's not reacting to emotion, he's measuring structural change. Michael Oliver consistently explains that major market turning points are not identified by price alone. They are identified through relative performance. And right now, his data is flashing something extremely rare: Gold has broken out against the S&P 500 after more than 11 years of sideways relative performance. Silver has now broken out against gold itself, and mining equities have broken out against both. Michael Oliver emphasizes that when all three confirm together, it historically marks the beginning of a leadership shift, not the end. This is why he keeps stressing that silver's move is not a speculative spike. It is the resolution of a multi-decade compression. For decades, silver was suppressed relative to gold. That suppression created frustration, doubt, and underallocation. But long periods of underperformance are exactly what build the energy for explosive repricing later. In Oliver's framework, silver is now transitioning from a laggard into the primary driver within the metals complex. And historically, once silver takes that role, the move is not slow. It is fast, volatile, and emotionally shocking. The question isn't whether silver has already gone up. The question is how long it stayed artificially undervalued. Let's hear what he says.
I wouldn't try to find a reason. The reasons exist on a macro level, and they recur, over the past century, especially when we've really gone to fiat money, unbacked currencies printed by governments where, the value of the currency unit just continues to decay. You could say, well, what does it cost in euros, or what does it cost in yen, or what does it cost in dollars? Has my stock gone up like it doubled over the decade, let's say? Well, it's a money supply degraded by almost that much. So you're really not making money. Okay. This process has been ongoing for like 100 years now. So one long human lifetime. And that's about how long the Fed's been around also. This monetary manipulation destroys certain things, like people's ability to calculate their budgets, where they're going to be in a year or two in terms of needed income. All these things change, and sometimes they can change more speedily. And that creates, especially when our stock market turns down, that will be an emotional factor, and we think it's stopping. And I think it's going to turn down hard early next year. Once that occurs, people feel pain. And when they feel pain, they get emotional. In other words, right now, everybody can look at their 401k or their retirement account if they've got one, and they're near retirement, and they say, oh dear, we're okay. We've got, X amount in our retirement account. If suddenly 20, 30% of that goes by the way, it doesn't come back, then they look around the horizon and they don't see anything that makes them feel good. Therefore, emotion hits. That's when you enter periods where political upheaval can occur, where people get PO'd at their governments. Even governments can't explain and try to push away. I'll give you a recent example. Here in the US, the head of the Fed in New York, a guy named Williams, about early last month, said that the Fed's going to need to start buying bonds, quote, bonds. Okay. What for? Thought everything was okay, guy, And he said, oh, no, it's just due to liquidity. Not that something's really wrong with the U.S. government debt market. It's just liquidity. We need to provide more liquidity. Well, that's a sign of panic on their part. And they never phrase it that way. But you got to watch these big assets like the UST bonds, because a lot of people have viewed them as an alternative. Hey, if I don't like stocks, I'll go over to T-bonds. 60-40 principle is very popular. That's come into doubt lately. I think it was even Goldman Sachs put out a statement saying, hey, it needs to be 60-20-20, 20% being gold. So anyway, these kind of changes occur, and they're massive, and they're everywhere. They're not just one issue. It's not just tariffs, which is really a new issue. And yet gold's been going up for, since 2015. Would you anticipate the tariff problem? No, that's not the issue. It's the ongoing degradation of a core of the economy called the money unit. The stock market breakage will cause the emotional wave because not much else is doing well. Like T-bonds, for example, they're not behaving well at all. It looks like if you buy them, you could get flushed, meaning higher yields, lower price. In fact, the recent downside action in the U.S. government 30-year T-bonds don't look good to us. So you drop another about 3 points in that market price-wise, and you could see the bottom come out and hints of panic on the part of the central bank. And these type of things will create events. They're embedded in the errors that are built into these markets pricing. So if the US stock market is a bubble, which we argue it is, beyond any bubble we've seen in terms of years of gain, percentage gain, it beats 29. It beats 1973 when we crashed into 74. Et cetera, et cetera. It beats them all in terms of longevity and error of pricing. And you say, well, it's because of a good, strong economy. Yeah, right. Look at an M2 chart, money supply. It's like an upward curving arc, okay? And look at Fed funds. They're control the short end of the market. Fed fund rate got up to like 5% recently, and people say, look, they raised. That is one of the lower levels of the last 75 years. It's like in the lower quadrant of interest rate levels going back 75 years. So even that rate rise from zero in 10 of the 15 years, we've had free money. So if you remember Cheech and Chong, the drug guys, this is a Cheech and Chong market. It's been drug fed by the central bank. And therefore, they've made errors. People have made errors, personal errors, investment errors. Companies have made errors based on what? Assumptions about the price of money. And anyway, so when all those errors get expunged or plunged out of the system, pain will occur, in the street type pain, like we had in 2008 and 9. And that's when central banks go berserk, even more so than they already are. Remember back in 2008, Bernanke did QE, print, print, print. Stock market continued down for 6 more months. Gold exploded. That's the kind of environment we're in. It's not one issue, it's multiple. Silver is both a monetary metal for thousands of years, like gold. In fact, India is moving toward monetizing silver now. But it's also very undervalued to gold. If you go back like the last 50 years, we're trading in the US of gold and measure silver versus silver in 20 of those 50 years was at least up to 2% of the price of an ounce of gold. Okay, right now we're 1.4%. Okay, very low. But in bull years, like in 79 and 80, when silver went up to the top of that old range, $50 highs, and in 2010, 11, when it went up to 50, it got up to 6.5% price of gold and 3.5% of the price of gold. Right now we're 1.4. We're in a bull market. If silver goes and does what it did back then, you could see it double to triple its value relative to gold. So if gold goes up another 50%, silver, off the page. Another feature. We ran a bunch of charts a few months ago showing long-term price of copper and lead, exciting metals, right? Okay. And they were in a range, a price range, look, a boring range-bound thing from the 70s, 80s, 90s into about 2005 for copper. So about 30, 40 years in a range, either side of about $1.50 or whatever. It broke out in, I think it was mid 2005. And in a matter of a couple quarters, it quadrupled in price by 2006. Well, you say, what excuse? It really wasn't one. A year or so later, lead did the same thing. And when it moved out of the old reality to a new one, it quadrupled. Why can't silver do the same? If it did, it'd be $200.
When you strip away the noise and look at the structure, Michael Oliver's message is unmistakable. This is not a late-stage silver rally. It is the early resolution of a multi-decade compression. Michael Oliver's momentum and relative performance work shows that silver has only just begun to outperform, first against equities, then against gold. Historically, that sequence has never marked an ending. It has marked the start of silver's most powerful advances. According to Oliver, silver is still priced as if this were a normal market cycle. But nothing about today's environment is normal. Currency dilution, asset exhaustion, and liquidity dependence have fundamentally changed the landscape. And when silver finally reflects that reality, the move is rarely slow and never quiet. This is why Michael Oliver keeps emphasizing that the real opportunity isn't in chasing price. It's in recognizing what phase we're in. Silver spent decades being suppressed, ignored, and underestimated. Markets don't correct distortions like that gently. They correct them decisively. So the real question isn't whether silver has already gone up. The real question is whether you understand what Michael Oliver is actually signaling before the rest of the market catches on. If you value analysis grounded in structure, history, and data, not hype, make sure you subscribe to this channel. We focus on the signals that appear before the headlines, not after. And now I want to hear from you. Do you believe Michael Oliver is right that silver is entering its most powerful phase? Or does the market underestimate it once again?